Merry Christmas, everyone. How's my how's the sound coming through? Merry Christmas, Louis. Anybody trading this Christmas Eve day? I'm done for the day. It's a short day. I just want to get a couple dollars out. Um, I mean, I got. If you saw, this thing just went up and then just crashed right down. I mean, I got out right at the top here almost of this bar. Wow, it's crazy. It's gonna be probably a choppy day. Uh, maybe. Everybody's hoping for a Christmas rally, right? But that doesn't always happen. So, um, so as you can see here, we gapped up. But the thing is, in the 15-minute chart, I was looking at it, it kind of wants to go to the 200 here and then possibly just crash down because of this huge move up. So we had to pull back up. We'd failed to make a new high. We pulled back again. So it might be a sideways kind of market for 4 hours or so. I think the market closes at 10 o'clock Eastern time. I mean Pacific time. So 3.5 hours, right? So, but it does want to go higher. We'll see what happens. But the thing is, here on a 2-minute chart, these tails are worrisome. Just rejection. So this might be the kind of day. It's just gonna be back and forth. So I'm done. I'm not I'm not pushing it. Just take a couple dollars out and enjoy the day. The market is closed tomorrow. Um, take a look something here. Yeah, markets are closed tomorrow. Just want to double check. Um, but they will reopen. The futures market will reopen. Um, 3 o'clock in the afternoon. So, well, it looks like it wants to go higher, like I said. But there was, these tails are just worrisome. So once we cleared above this, um, we're good to go higher, right? To the 200 on the 15 minute. The problem is we have these on a 1 hour chart. We got these moving averages declining. So like I said, it might go to 21,900, maybe 950. I mean, that's a stretch, right? For a short day. But low volume and short days. I don't know. It's anything can happen, really. But like I said, I'm done for the day and just gonna watch the market for a while, see what happens. We can talk about if you have any questions, concerns. We can talk about it. Yeah, it's definitely want to go higher. God. So, um, well, we might hit 950 with this 15-minute bar, almost at 900. If this bar gets magically erased completely with one swoop, we're going lower. This could be just a fake out. So we got a minute left and it's already 60% erased. So what's going to happen? What's going to happen here? For the bulls to give up that much, it's worrisome. It's kind of like right over here, this big bar, then it came back down almost. So we might see the same thing, right? We'll see. We might not. Let's see, this is roughly 38. Yeah, wow. So many similarities here and here. We'll see what happens here. Looks it's coming back. Happy holidays, Merry Christmas. Oh, it was just a fake out. I mean, what would they? 10, 20, 30 points. Just give up 30 points like that. But then again, here's a 15-minute chart. Well, we got to 900, like I said. Now the question is if we're gonna get to 950 or 945 area.
you
Kurwa ty zajebańcu, no. Noż ty kurwa ty zajebańcu, no.
you going to help each other. Going to do the obvious synergies that mean purchasing together, but this is stuff that everybody has already done. There is no obvious sophisticated synergy to happen when you look at the footprint of the two companies. Maybe in the future, but it still have to be demonstrated.
Is there a deal that makes better sense in your mind?
Well, I was very interested when Foxconn said they are interested in Nissan. I said, oh my God, that means something creative here. We have something new coming. You know, because this is a huge company wanting to have their own electric vehicle. Here you have a total complementarity. There is absolutely no duplication between the two companies. But this is where I think at the end of the day, the métier has the last say. That means, okay, no for a Chinese and obviously yes for Japanese.
I was going to say, do you really think the Japanese government would let a Chinese company come in and take Nissan? They had their questions with you about a French company, right?
Yeah, they tried their shot. Yeah, Terrigo and the Foxconn people, which is fair. But frankly, if they really want to go to EV, they will have to choose, because there are so many weaklings today in the car industry, particularly in the generalists, the people who are not specialized into one sector, that they're going to have the choice to go for somebody else.
Well, what is the future of Japan's auto industry in light of what we've seen from the Chinese EV makers and their advanced technology, their lower prices, and what we're seeing from Tesla here in the U.S.?
Look, for the last 10 years, the big winners are obviously, when you look again at the data, are the Tesla from one side, and from the other side, the Chinese automaker. Not all of them, but the top Chinese automaker. They have been the people on the offensive, the people who are gaining market share, gaining in technology, and moving up into the level of cars that they have. And most of the very established group have been on the defensive. Some of them successfully, like, you know, Toyota is still doing well. Mercedes is still doing well. And others are struggling because there will be no place for weak or common generalists in this market. I think you're going to have specialists, you're going to have EV makers, the environment, and you're going to have a lot of technology, autonomous car, connected cars. All of this is going to really change and transform this industry. And the companies which are not really well managed are going to suffer.
Since we're talking about Tesla, Carlos, we might as well talk Musk. I'm curious as to how you're viewing what's happening here in the United States. His political influence has obviously grown tremendously over the last handful of months and only seems to be expanding within what will be the new Trump administration. What's your view?
Look, I cannot talk about the situation in the U.S. because I'm not living there and I'm following the news and I'm a little bit careful about how to interpret them. But I can tell you what Elon Musk has done in the car industry, which means sticking to EV from the beginning, going through tremendous difficulties, because you know that Tesla was near Chapter 11 a couple of times. But he was persistent, he was focused, and he really played very well this image of technology. It was not only a game, it's also a reality. He's done a remarkable job. And I'm not surprised that today he, by himself, with Tesla, represents 50% of the total market capitalization of the industry. It's amazing.
Well, let me just ask you this then. I understand, you know, the way you answered that question, and I respect that. But how do you think the other leaders of the auto industry, whether it's in the United States or globally, should view Musk, given the political influence that I suggested he now has?
Well, he's obviously a powerhouse to count on. But, you know, when you look at the total industry, we're talking about maybe 70 or 80 million cars sold a year. Tesla is not a big player in volume. You know, I don't know the latest number of Tesla, but they are in turn probably of 3 million cars or between 2 and 3 million cars. So these guys sell probably, 4 or 5%, represent 4 or 5% of the volume of the industry and 50% of the market cap. It's remarkable. It's remarkable. Obviously, it's a good tribute to Tesla and to Elon Musk personally. And but also it's embarrassing for the other car makers that somebody who is not so big in the car industry can represent such a big portion. Because that means he has a vision and there is an image about Tesla that the market is ready to pay a very high price for.
But there's also this question, Carlos, about whether the future really is EVs and whether Americans want EVs, because this administration, the Biden administration, has pushed it really hard, and the companies like GM's have had to scale back their aggressive EV targets and plans because Americans don't want them.
Yeah, I agree with you, Sarah, but I think this is a pendulum. I think today maybe there is some resistance to EV in the United States for obvious reason of cost, mileage, etc. But I think the environmental constraints are such that we cannot escape this. Even though you're going to have a pullback for a period of time, it will come back. So, and all the car makers, as you know, they're all global. They have to compete in China. They have to compete in Europe. So the technology of EV is absolutely necessary for them, whether they are using it today in the United States or they are not using it. So at the end of the day, I think it would be extremely imprudent for a car maker to just, reduce their pressure on investments on EV, because without any doubt, in the main market of the world, which is China, EV is a main player.
Well, it was valuable to have your commentary, Carlos, on the Nissan-Honda merger. I do want to ask before we go just about you, as we reported over the years extensively, and sort of the fugitive status wanted by France and Japan. You're in Beirut after the dramatic escape now almost 5 years ago. Hard to believe. What is the status? Is there any update on your legal proceedings?
Well, legal proceedings, unfortunately, are very slow, particularly when there is obvious bad faith from one side. But the origin of the problem is Japan. It's not France. Because what happened is when I escaped Japan, the Japanese refused to transmit the file to the Lebanese authorities so justice can be made. But they transmit the file to the French. And now the French are a little bit the heirs of the Japanese file pursuing this situation. So if we can solve the problem in Japan, I think the whole problem will be solved. We're not there. It's going to take a lot of work. It takes a lot of patience. As long as there is in front of us possibilities, I'm going to continue to fight. It's a tough fight because I have in front of me people who are really want to punch me.
Well, Carlos, appreciate the update. Thank you so much for coming on. It is good to see you.
Thank you, Sarah.
Carlos Ghosn.
All right, still to come, we are monitoring the airlines today following that American Air grounding earlier this morning and the potential impact to the very busy holiday season. And as we head to break, Broadcom, Tesla, Palantir leading the S&P this morning, adding to their gains for the month. We'll be right back. Markets are rallying.
tradingview.com.
Welcome back. I'm Seema Modi with your CNBC News Update. The judge overseeing the trial of a man accused of attempting to assassinate Donald Trump on his Florida golf course pushed his trial date to September of next year. It was originally set for February, but she said there was too much electronic evidence to search through. Ryan Root's legal team also asked for more time to consider invoking an insanity defense. Israel's defense minister confirming Israel assassinated a top Hamas leader last summer. His comments mark the first time Israel has acknowledged being involved in the death of Ismail Haniyeh, who died in an explosion in Iran in July. The special prosecutor in the manslaughter case against Alec Baldwin withdrew his attempt to reinstate charges. He said he faced multiple barriers in pursuing the appeal. A judge dismissed the case against Baldwin in the summer, nearly 3 years after a prop gun he was holding on the set of the film Rust discharged, killing the film's cinematographer, Helena Hutchins. Sarah, back to you.
Okay, Seema. Do not forget, you can now catch the 10 a.m. hour of Squawk on the Street anytime, anywhere. Just listen to and follow the Squawk on the Street podcast. It is available now on Spotify, Apple Music, and more. We've got the Dow positive along with the S&P and the NASDAQ, which is still in the lead. Story of the year, of the month, of the week, and of the day. We'll be right back.
Decade? No?
I have to check.
We continue to monitor the airlines this morning following American Air's grounding earlier today for about an hour due to a technical glitch. CNBC's airline reporter Leslie Joseph, joins us now to discuss. It's good to see you this morning. Do you feel like we have a better handle now on what exactly caused this?
Hi, good morning. Well, it does look like a technical glitch, a key piece of software that customers generally never see. It feeds key information like the aircraft's weight and balance, how many people are on board, kind of the heart of a lot of the back-end data that is required to get planes off the gate and moving into the skies. And that is something that failed. Luckily for travelers, that didn't last very long. It was about an hour, and American Airlines has just told us that they don't expect any cancellations, at least so far, to come as a result of this brief outage.
Wow, so they haven't had any cancellations. Presumably, though, they've had a significant amount of early morning delays that they now have to work back through.
Yes, that's true. We are expecting some residual delays throughout the day. If we do see cancellations later on, it could be, maybe crews are timing out. One thing that is working in the airline's favor is this is a pretty low schedule. Not a lot of people are traveling today. It's the second lowest scheduled day after Christmas Day for the entire holiday period. Airlines are expecting, American included, are expecting a record travel period. So they are lucky that they are flying about 4,000 flights, a little bit less today, and that compares to close to 7,000 in the days leading up to Christmas Eve. So they are lucky in that sense, and they're just kind of working through it now, getting travelers on their way. They are lucky also that this happened very early in the morning, not in the middle of the busy schedule. So they're trying to reset as quickly as they can.
Do these airlines have outdated technology? Do they have too much technology? Are they just in the crosshairs because so many people are affected with flights? Like, is there a technology problem that this keeps happening over and over again at some of these carriers?
That's a really good question, Sarah. I mean, we've seen these very high-profile meltdowns. We saw Delta struggling to recover from the CrowdStrike outage over the summer. We saw Southwest, of course, 2 years ago with the Christmas period, major meltdown, struggling to recover. What airlines have is a lot of different systems that perform a lot of different functions. There's some software that is for crew scheduling, and that's kind of what did Southwest in at that time. They have different computer systems for different things, reservations. Sometimes when one thing fails, the easiest thing to do is call a ground stop that holds aircraft at their origin so they don't take off and overload airports with inbound planes that have nowhere to park, and so that airlines could kind of reset and get on their way. But there is a patchwork. Many of these systems are older, dating back sometimes decades, and they all need to work together, and they need to work together perfectly for things to operate smoothly.
So once we get past this, what's the setup for them in 2025? Because we were talking earlier about the market divergence between United, which has trounced some of the others in terms of performance, and Delta versus a JetBlue or an American.
Well, United has had this runaway year. Shares have more than doubled. They've really just wowed investors this year with their performance. United is trying to catch up to Delta, the most profitable airline. All of the airlines are really trying to go after that high-end passenger, adding premium seating, first-class seating, updating their lounges, updating their credit card deals so that they can get as many high-paying customers on board. What we heard from American, United, Delta, and even JetBlue and some of the smaller players is that demand does look strong going into 2025.
Leslie Joseph, thank you very much for all the perspective on what happened this morning with American.
Thank you.
The entire industry. You too. Still to come, the M&A playbook under a second Trump term. We're going to discuss with a former FTC commissioner. As we had to break, let's get a check on the markets. Again, strong session, and we have just gained momentum throughout this hour with the S&P now up almost 0.75%. It's broadened as well in terms of sectors. We've gone to almost now every sector being higher in today's trade. It is technology leading. That's why the Nasdaq is up almost a full percent. We'll be right back.
Happy holidays, MS.
You know.
All right, the FTC under the Biden administration blocking several high-profile mergers in recent years, challenging deals including Kroger's, Albertsons, and Capri Tapestry. Now a government panel deadlocked on Nippon Steel. U.S. Steel leaves the final decision on that deal to President Biden. Let's discuss what M&A could look like under the incoming Trump administration. Former FTC Commissioner Moselle Thompson joining us now. Happy holidays. Welcome. It's good to see you.
Hi, Scott. How are you?
I'm good, thank you. I mean, the assumption, obviously, you don't have to be a rocket scientist to hear what the assumption is that it's going to be way more merger friendly. But to what degree? Do the doors just swing wide open, or are there still going to be limits?
I think that it won't be as fast and furious as some people may anticipate. The FTC is engaged in, for example, some high-profile investigations and litigation. It's going to be harder to turn that ship around. What you may see is continued emphasis on enforcement, but the focus might be slightly different. So, for example, there may be a return to looking at empirical data, whether there's actual consumer harm in the form of prices, and the clawback a little on the broadening of some of the more innovative or novel approaches that the Biden FTC took on some of the legal cases. But you might see that. You also might see things in terms of changes in rulemaking. The FTC was involved in quite a bit of rulemaking. So, for example, in M&A, there was new Hart-Scott filing requirements. You may see a sort of toning down on that a little bit so they can make the regulatory burden a little easier for people who want to file for mergers. You also might see a change in some of the standards and what they might look at, clawback into a narrower view of what would be anti-competitive. Mm-hmm. So you'll see those things. You also see changes in other rulemakings in the consumer area. For example, they have new rules on junk fees, on the non-compete clauses, right, on click to pay. You may see a sort of clawback on those things too. So I would pay attention to that.
What I hear you suggesting, though, is that you said that the Trump administration is going to be more data-driven. What I hear you suggesting is that the current administration was not, and that it was more ideological for the reasons why these deals weren't done. Is that what you are suggesting?
No, I wouldn't say that. I think some people interpret it that way, but they added other factors to be considered, like job impacts and other things that may not have been traditionally looked at in antitrust. I think you might see a return to some of the traditional fundamentals here.
I wonder, is there any scope for DOGE, which wants to enhance government efficiency and cut costs, to do anything on the regulatory front from a structural perspective, like combine the FTC and the Department of Justice Antitrust Division, something like that?
Well, I think that's one thing that may be proposed. It's yet to be seen what DOGE's mission is going to be on the antitrust side. Whether it's going to be based on efficiency, reducing headcount, for example. But FTC legally is an independent agency, and it will take a lot to change that legislation in order to make that happen. But what you might see is some impact on the budget. And if you see some changes to the budget, then the FTC will be forced to change priorities about what it spends on and how it spends it. In which case, you may see some of the policy initiatives.
But is it redundant? Like, why do we have both of them?
I think traditionally the FTC has looked on certain categories and certain industries differently. And I think that one of the things, having a bipartisan commission, even though there's a majority in one party, and the administrative power to bring administrative cases to sort of flesh out new areas of law, makes the FTC different. And it's not really supposed to be guided by politics. So what you see is a different way of approaching those issues. And they're different industries. For example, things that deal with national security, defense, cars, those traditionally go to DOJ. Other issues, for example, like oil and gas, tend to go to the FTC. Supermarkets go to the FTC. And so I think it would be very difficult to really rejigger all of that in a very short period of time.
Mm-hmm. Moselle, thank you. We'll see you soon. And again, happy holidays to you.
Happy holidays to you.
Thanks.
Still to come, it's been a rough year for big booze. Constellation Brands, Brown-Forman, hitting new 52-week lows in today's trade. We're going to look at the potential headwinds and tailwinds for the group next year when we come right back. Dave.
It's been a very bad year for alcohol stocks. Most breweries and distilleries in the U.S. in the industry down double digits year to date. Brown-Forman, Constellation Brands trading at 52-week lows. Brandon Gomez joins us now with why the sector has been so beaten up and what is ahead for 2025. I mean, it really is, when you look at volumes, down a lot.
Yeah, a lot of depleting volumes in terms of sales as well. Beer, liquor across the category. Investors have really soured on the group. Constellation Brands back to lows of May 2023. Now that's before the Bud Light boycott. Question is a rebound in store for 2025? Investors watching President-elect Trump's proposed tariffs on Mexico and Canada impacting companies like Constellation Brands. Trade groups already petitioning for product exemptions around tequila, mezcal, Canadian whiskey. But then in the EU, you also have a 50% American whiskey tariff about to come back in March if Trump and European officials don't reach a new deal there. Add on changing consumer appetites, alcohol sales level setting, like you said, Scott, from a COVID peak era, and you see why investors are starting to back out. But what does it all mean for the trade? Well, for investors keyed in on tariffs, Modelo maker Constellation Brands, Brown-Forman, which makes American whiskey Jack Daniels, Smirnoff maker Diageo, stand to be hit hardest. Domestic brewers like Molson Coors, Boston Beer, even AB InBev are more durable, feel safer, but still down year to date. Now, it's not all kick taps and dry wells. Brown-Forman posted stronger liquor sales last quarter. Some recent street upgrades for Diageo and Molson Coors could signal a bottom for the category. Constellation gave investors a sigh of relief selling its struggling Svedka vodka this month. Reports Diageo is looking to do the same with Ciroc, the company offering no comment to me there. But it's clear executives are focusing on cleaning up the balance sheet and trying to improve as the year comes to a close.
This is what has multi reasons to it. GLP-1s playing any role?
GLP-1s.
Alternatives to booze?
Cannabis, right? As cannabis faces possible reclassification, that could eat into sales. Non-alcoholic trend as well.
But also these health studies. I mean, there have been a lot, and I feel like it's ramped up. News stories, health studies about how people should be drinking more moderately to protect themselves against heart disease, cancers. I mean, you name it.
And you've seen this generation to generation, right? Gen Z drinks less than X, drinks less than baby boomers. But what you really have to look at is that these companies are investing in non-alcoholic products, right? Molson Coors acquiring Zoa, an energy drink brand. I mean, Sarah, you follow the beverage space so closely as well. You have the Coca-Colas trying to get into liquor. Now perhaps you have some of these liquor companies trying to expand their portfolio more into the soft drink category.
Yeah, so it's a kind of an ugly set of headwinds for the industry.
Yeah, well, the question is the alcohol industry perhaps better positioned to enter the soft drink market than, say, the soft drink market is, going in the opposite direction? All those regulatory hurdles, those legal battles state by state.
Soft drink market has headaches, too. I mean, RFK Jr. wants to get them out of food stamps.
Yeah.
Anyway, Brandon, it's great to have you. Thank you very much.
We'll keep tracking it.
All right, take care.
Scott, it's been fun.
Yes, it has.
Merry Christmas, everybody. Happy Hanukkah. That's going to do it for us. The exchange starts right after the break with the early close for the markets at 1 p.m.
Welcome to the Exchange. I am Frank Holland in for Kelly Evans. Happy holidays, and here's what's ahead. The bull market is intact, but there is one thing our market guest says could derail it next year. She joins us with what it is and what she's buying with that in mind. Plus, the read on retail. Our analyst is seeing some clear trends emerging for the new year, and she brings the stocks that stand to benefit. Take a look. This is one of the names with gains in sight. That's kind of a holiday hint. It's up 78% this year. At me if you think you know what it is. I'm on Twitter, I'm on Instagram, I'm even on TikTok. And the stakes are high for Netflix to get it right from the technical to the bottom line. We look at why tomorrow's NFL games are critical for the streamer, but we begin with today's markets and a gentleman that knows all about sweater weather, Dom Chu with the numbers.
It's the holiday sweater season right now, right? Sweater is better than suits during this time of year, at least for me. Anyway, as we talk about the move in the markets right now, we're starting to see a little bit of a bounce. We're going to try to close out this holiday shortened trading day on a high note. For that matter, right now, we are right near session highs for the three major indices. The Dow Industrial is at 43,108. It's up roughly 200 points, or about a 0.5% gain. Even bigger percentage gain, 0.75% for the larger S&P 500. It's currently at 6,017. It's up about 43 points. At the highs of the session, we were up 45. So again, right near those session highs, up 7 points at the lows. That is your intraday trading range so far. Remember, 6,099 is the current record high level. The NASDAQ composite really leading the advance here. That tech-heavier trade up 1%, 197 points for the NASDAQ composite to 19,962. From a macro perspective, turning now towards the cryptocurrency side of things, we're seeing at least a little bit of a move within a broader trading range over the course of the last month and a half or so. Bitcoin price is currently at 98,200. That's up about 5.5%, so a strong move higher. Now, this is the range that we're dealing with. Remember, on the high end, since about November 11th, we're talking about 108,000 thereabouts per Bitcoin, and about 88,000 on the lows since, again, the middle of November. So that is your kind of range so far, a $20,000 range, at least medium term. Keep an eye on that. And then from a rate standpoint, it's hard to believe, but we're right now near session highs for the 10-year note yield. So again, bonds for the U.S. government selling off in value, the yield's rising to 4.62% over the course of this kind of year-to-date period. The lows that we saw earlier this fall, currently around 3.62, and then 4.62 at the high. So a full percentage point in terms of yield difference between the lows of the year and the highs of the year. We'll see if that becomes a theme going into 2025, Frank, for those yields. I'll send things back over to you guys.
All right, Dom, thank you very much. Well, as yields rise, probabilities for rate cuts next year, they continue to decline. CNBC senior economics reporter Steve Leisman has more. Steve, happy holidays. Good to see you.
Hey, Frank. Yeah, happy holidays to you. Well, optimism and uncertainty look to be the two main, and I'd say conflicting themes for 2025. Consider some of the data we got just this morning. The outlook in the Philly Fed's non-manufacturing index shows the optimism that we've seen in business survey after business survey. The outlook hit a new three-year high, eclipsing last month's three-year high. Expectations in the Richmond Fed's manufacturing outlook also this morning showed several components reaching new multi-year highs, and much of that optimism has got to be linked to high hopes from policies from the incoming administration. But an offset to all that optimism comes from the outlook for Fed rate cuts. Futures markets have dialed in one rate cut next year, but they are decidedly unsure about a second. That trades with just a 40% probability in December. That's the bar on the right of your screen, the probability for a second cut. The 10-year, it's gone the other way while the Fed has cut rates. While the 10-year yield, it did decline. You can see there in anticipation of those cuts. 100 basis points of cuts actually delivered from the Fed, offset by 100 basis points of gains in the 10-year yield. So those are the themes so far, optimism versus uncertainty. You have deficit hawks out there in the GOP versus the president-elect wanting to cut taxes and all the promises he's made there. You have Fed rate cuts versus still sticky inflation and potentially expansionary fiscal policy. So a surge in the economy in 2025 fueled by tax cuts, deregulation, but offset by tariffs and still high and maybe growing deficits. That's going to be seen as increasing the inflation risk by the Fed. They've already upped their inflation risk outlook. That's going to mean a more cautious Fed, more cautious to cut in 2025 until, Frank, the outlook becomes less uncertain.
All right, so Steve, really interesting data there. You know, Steve, by the way, I like to think of myself as the junior economics reporter. So I have a question for you. Aren't we really just one jobs report, one inflation report away from all this changing again? I mean, the dual mandate is the key. Jay Powell stressed the importance of the jobs market several times, and then he's even referenced inflation this time. If we see a meaningful change, doesn't that just change the outlook altogether?
I think it could, and I think what's smart about your question is we're coming out of a period of a lot of distortion in the jobs market, in the jobs reports we've had. You had those hurricanes and the strikes, then you had the bounce back from them. So the December report, even though there's going to be a lot of holiday hiring and firing and all that stuff, seasonal stuff, it'll at least be beyond those restrictions, Frank. So if we do get a weak report, I do think it will increase the odds of that second rate cut being in there. But that's not going to undo the uncertainty that's out there. More broadly, though, your question is if there is broad economic weakness, then I think what you're going to do is you're going to have the market not be concerned so much with the outlook for deficits and expect more fiscal spending and probably more rate cuts. So you're right, a broader weakness that would probably change things around.
All right, next jobs report coming up in that first week of January. We'll have to wait and see. Steve Leisman, great to see you. Enjoy the holiday.
Actually, it's the second week, I think, Frank. I think it's January 10th. Just mark, and it's a weird one.
Well, I'm counting it the first.
It's a weird one.
Within the first couple of days, but generally it's in that first week.
Well, if you take off the first week, then it is the first week. Yeah.
Steve, I hope you're not taking off. I'm hoping to see you, but as you mentioned, it is January 10th. Steve Leisman, great to see you.
Okay, good.
All right, my next guest says the biggest risk in 2025 is policy error, including a possible mistake by the Fed, which is a sure way to kill off a bull market, in her opinion. Joining me now is Victoria Green, Chief Investment Officer at G Squared Private Wealth. Vicky, happy holidays. Good to see you.
Good to see you, Frank. Merry Christmas.
Merry Christmas to you as well. All right, so you're worried about some type of policy error. What are we talking about? Are we talking about possible tariffs? Are we talking about the Fed cutting its outlook from 4 to 2 cuts? What is it that you're so concerned about?
It's the concern the Fed is too early, too late, too slow, too fast. They have a very thankless job. If they get it wrong, like transitory and inflation, then it could certainly derail the bull market. We're calling our outlook for 2025 bullish with a but, because now we have so much uncertainty, like you and Steve were just talking about. We have issues with, could we see major cuts to government expenditures? Could we see major cuts to government employment? Both of those could destabilize the Fed path. Could we see the Fed be too early or too late and destabilize some of the stability we've seen and the rates market? Absolutely. So for us, policy error is always the tried and true way to kill off a bull market. It doesn't die from old age, doesn't die from high PEs. Bull markets can be killed off, though, by policy error, and those stakes continue to rise next year because we have so many uncertain things that may or may not occur.
So, Vicky, did you think that the hawkish cut that we got on the 18th, was that a policy error? And I know you're very bullish on growth and on tech. If you look at the charts, ever since that cut, you see the Mag 7 underperform the market. You see software underperform the market. If you look at the IGV, you see cybersecurity underperform the market. I mean, just about everything's underperforming. So in your mind, was the hawkish cut the policy error that the market needs to worry about?
I think it was. I saw no reason for another cut. And I think they did need to rip the Band-Aid off. I was happy to see the dot plot recalibrated, because if we're seeing strong economic growth, stability in inflation and employment, why is the Fed continuing to cut? I also thought the 50 basis points earlier in the year was not needed. We weren't in some emergency situation. So for me, I feel like they've reacted a little bit too harshly. I think that's one reason we saw that huge sell-off on last Wednesday when they said, oh, hey, maybe we've moved too fast. Now we're going to take our foot off the gas. And the market again had to strongly recalibrate to, okay, now we're expecting 1, maybe 2 cuts next year, which is what you should have if you have stable and growing economic policy. And if we have a GDP growth situation, if we have increased earnings, we shouldn't be cutting. We should only be cutting if inflation's go in the right direction and it's been very, very sticky, or if unemployment picks up, which is likely the bigger risk I see, especially if we do see the Doge committee go into full swing here and we start to see the size of the federal government and possibly state and local governments shrink as they react to that.
All right, so we'll get some answers on that coming up on January 10th with the jobs report. I do want to ask you about 2 other areas that a lot of people I'm talking to are concerned about: the rise in the dollar up more than 1% since the Fed decision. Also, the rise in bond yields up more than 20 basis points since the Fed decision. Does that make you at all concerned about Q1 earnings, just some of this pressure from those 2 areas?
Yes, the U.S. dollar going up is a huge concern. Multinationals have a lot of more exposure to that. You look at some of the companies like Pepsi has about 50% of their earnings are coming from outside the U.S. So we do think there's some risk. You could see some U.S. dollar drag. I think some of it's going to be explainable, that it won't be quite the knee-jerk reaction if they say, hey, we missed, but here's our currency drag, and investors may be able to take that with those grain of salt. On the yields front, I think we're okay unless we hit 5. If we start creeping up towards 5% on the 10-year, I get a little bit more concerned on what that does to U.S. growth markets and longer duration equity assets. Absolutely. In this area between 4.5, 475, we've been here before this year. I'm not too concerned yet. But yeah, if we break out of 475, head to 5, then I get a little bit more concerned about the yield drag. Absolutely.
All right, by the way, we're showing your S&P 500 price target for next year, 7,100. You're one of the more bullish price targets I've seen when it comes to the S&P. I want to get to some of your picks. You have a couple of them for us. Netflix, we're going to talk about that later in the show. Also, Energy Transfer, Constellation Energy. I want to get to your other one, Blackstone, having a very strong year, up about 30% year to date. I do want to ask, though, what is it you like about this alternative player here? When I look at the valuation, it's pretty expensive at about 32 times. This is a market that seems like it's priced to perfection, and now we're seeing some weakness due to these elevated valuations. Is there something in Blackstone's business in particular that you like? Because I look at some of the other names, much lower valuation when you look at an Ares or a Carlyle.
Sure. I like Blackstone because of their scale, and I think you're actually going to turn the corner on them. They are heavy real estate. BREIT's one of the largest non-traded REITs out there, and we're starting to actually see realizations pick up. Barclays just sat down with their CEO, and they're talking about 2025 outlook. Finally might get some things off the book, get things moving, get more realizations, IPOs, and that'll definitely help the stock. But it's not just about that. They continue to grow. They're over $1 trillion in assets. Their scale is massive, and the next frontier continues to be retail clients and the holy grail, which is ERISA plans and 401ks, which is a long game, but we see them pushing into that with the interval funds. And I think their known scale, their sales distribution network will allow them to continue to grow their product. They were up 40 billion in new assets just last quarter. And I think they're going to continue to grow and justify, and their fee revenues continue to grow and justify this multiple. So yes, is it cheap? Absolutely not. But I think it's worth the premium here because of its growth outlook and its ability to push into new markets. Look at the rise of private credit. I think you're going to see if the yields continue to come down on this front end, you're getting a lot less in money market, short-term bonds. You know, everybody's been doing T-bill and chill. Suddenly you might get pushed out of that a little bit next year, and you might be looking for alternative ways to generate more with less maybe volatility than intermediate treasuries. You could be seeing more and more flows into the private credit sector. So I'm very bullish on the stock. Absolutely.
All right, Vicki, before we let you go, I do have to ask you about the financial sector, another area that you're very bullish on. The Bank Policy Institute actually suing the Federal Reserve over the annual stress test. Your view on that? I know you're worried about policy. I mean, this is obviously the big banks pushing back on policy.
Yeah, I think this was I think every institution is going to be pushing back, every industry after the Chevron decision here saying, hey, we want a lighter regulatory touch. So they did talk about the fact what they were asking for was public comment, and the Fed came out saying, hey, we are going to possibly be getting public comment. So they said, hey, we want to get this lawsuit in the books just in case it's not the way we see the Fed going. The Fed was already moving in ways to kind of appease this group, but the Fed acknowledged, hey, after the Chevron decision, regulatory agencies might have to have a lighter touch, which again makes me very bullish on financials. If we see less issues with stress tests, less issues with capital controls, less issues with, hey, your balance sheet has to be exactly this. Banks can lend more, banks can make more money. And I think some of this was a little bit, the Fed kind of ran it a little bit, but they still wanted it in the books just in case it's not what they wanted to see in 2026. They've got this lawsuit ready to go.
All right, Vicki Green from G Squared. Great to see you. Enjoy the holiday. I'm sure I'll see you soon.
Thanks, Ryan.
All right, time now to turn to retail and the consumer, of course. Christmas is tomorrow. Visa out with new data showing holiday retail spending. It increased almost 5% year over year. That's despite a shorter shopping window between Thanksgiving and Christmas this year. But the outlook from here becoming more uncertain with consumer confidence dropping and tariffs cited as one of the reasons why. And that's why my next guest is watching as what she's watching as well. For more on the potential impact of tariffs on retailers and the name's best position in the new year, let's bring in Dana Telsey, CEO and Chief Research Officer of Telsey Advisory Group. Dana, happy holidays. Good to see you.
Happy holidays. Nice to see you, too.
All right, so Dana, answer this question for me. I've been talking to a lot of people about the retail sectors. We talk about it on my show, Worldwide Exchange. Are tariffs just bad for retail overall, or are there some companies that might actually benefit?
Well, when you have companies, some of the companies make a lot of the goods here in North America. they'll benefit. You look at Bath and Body Works, where 85% of their goods are made in North America. That's an opportunity for them. You look at Birkenstock, where most of their goods are made in Germany and in Portugal with the cork. That'll be fine for them. But the speed to diversify your sourcing, because there is no China like China, is something that all our companies are gravitating towards. And a lot of it certainly is in the athletic area where there's been more exposure.
All right. So if companies are looking to diversify their supply chain, generally that increased costs. Does that mean that cost is going to be passed on to consumers? When I look at the credit card data, record high levels of credit card debt right now, 1.16 trillion. Should we be worried about higher prices in the new year?
Yes, with tariffs coming, and if they do come, and most of the retailers and brands have to pass on the price increases, that is a headwind. And that's why you're continuing to see the value retailers, whether it's the off-pricers, whether it's discounters like Walmart, continue to gain share. And you're seeing more brands even sell through these value channels.
One other question I want to ask you about, this is a little bit in the weeds, but I was talking to some traders about this, about retail in particular. When it comes to tariffs right now, there's an exemption. They call it a de minimis exemption that basically leaves goods from companies like a Shein, a Temu, untariffed. So if that was taken away, it would hit those fast fashion names. Are there other companies, publicly traded companies, that would benefit if the cost of Shein and Temu and those other fast fashion names were just higher?
When you think about fast fashion overall, take a look at the Inditexes and the H&M. H&M makes around 25% of their goods in China. The umbrella that you have with off-price, and off-price would be a beneficiary, is they're always priced lower than brand names. The other area that you would have is when you look at many of the specialty apparel retailers, even companies like Abercrombie and Fitch, where they've gotten their sourcing from China down to single digits. And I think it would benefit some of those retailers also.
All right. One other thing you're watching is supply chain. I was actually just talking to a big logistics company today just about customers pulling forward ahead of tariffs, ahead of a possible port strike. Also, Lunar New Year is a bit earlier this year, so it's like 3 big things coming up in January that could really jam up the supply chain. Is that almost definitely going to raise the price of a lot of these things that are getting pulled forward? From what I'm hearing, higher margin, big ticket items. I mean, for big screen TVs or high end retail, does that automatically push up the price? Or do you think retailers, do they absorb some of those costs?
I mean, it's always a little bit of absorbing costs, and it's always passing some of it on. We know from the tariffs last time, retailers passed on some of the costs. What's different this time is the agility that many of the retailers have in order to diversify, in order to manage their cost structure. They're able to deal with it, but not if you have China, Mexico, and Canada. There's only so much wiggle room that you have of where to source merchandise, except for companies, like I mentioned, Bath and Body Works and Birkenstock.
All right. I want to get back to our mystery chart. You said that you could see some gains in the year ahead. It's Warby Parker, by the way. What is it about this eyeglass retailer that has you so bullish about it?
You know what I like about Warby Parker? You take a look at their retail stores, they're crowded. You look at the expansion that they're doing of their customer base with partnering with insurance companies, they're getting an increased customer base. You take, or not an increase, you get more customers. You take a look at what they're adding on, the optometrists in their stores, and where do most people buy glasses? There's an attachment sale from where you get your eye exam. And adding contacts and progressives, and the fact that some of the new stores are operating at higher sales capacities and higher sales plans than originally expected. And don't forget that you also have their online business too. So it's growing. You have the benefit post-COVID of now people coming back and buying glasses. And glasses aren't just for essentials, they're for fashion too. They get a little bit of both, and I think they're winning in 2025.
Yeah, it sounds like a very interesting business model. I don't wear glasses. I've never been in one of the stores, but if you can get your eye exam there and buy your glasses there, I'd imagine that leads to a lot of sales. Dana Telsey,
exactly.
Really great to see you. Have a great holiday.
You too. Happy holidays.
All right, coming up here on The Exchange, retail isn't the only group with a lot at stake this holiday. Netflix's live event coverage facing a real make-or-break moment. The Tyson-Paul fight, that was kind of a technical train wreck. Can Netflix, can it handle the NFL? That's coming up next. And welcome back to The Exchange. Tomorrow, Netflix and the NFL, they're teaming up for the very first time to stream NFL games. The streaming giant is bringing 2 Christmas Day games to subscribers as it looks to expand its push into live programming. Our Julia Borston has more on what to expect in today's Tech Check.
Hey, Frank. Well, Netflix's estimated $150 million deal for 2 NFL games is designed to be a win-win, giving Netflix valuable content to power its new ad business and giving the NFL massive global reach. Netflix shares are up nearly 90% in the past year, in part on the potential of Netflix's ad-supported lower-price tier, and sports are a key way to drive real-time viewership that's essential for advertisers. Oppenheimer estimates that Netflix is generating $150 million in ad revenue between those 2 games tomorrow, which is the same as their licensing costs. So Oppenheimer says the games offer huge subscriber acquisition upside. Now, if tomorrow's games work both technically and by reaching a new, more global audience for the NFL, it sets the stage for the NFL's continued global expansion. The NFL plans a record 8 international games next year, up from 5 this year, as the NFL considers as many as 16 international games in the future. And the NFL does have the opportunity to renegotiate most of its contracts early after the 2028-2029 season. And Netflix could be a natural fit as a buyer for a new package of international games.
The reach is global, and you'll see global franchises like Squid Games and other programming that has really worked across the planet. That is given us the opportunity for the first time to think of one partner and think globally at the same time.
As for concerns about technical glitches in last month's Mike Tyson-Jake Paul fight on Netflix, sources tell us the NFL commissioner is confident in Netflix's streaming capabilities and that he is in close touch with Netflix co-CEO Ted Sarandos. Frank?
All right. Thanks to our Julia Borston for that. My next guest says, well, shares have performed much better than he expected. He thinks growth is likely to slow down from here. He has a neutral rating and a $680 price target for the stock. I stumbled because the stock's trading at about $930 right now. Let's bring in Barton Crockett, Senior Analyst and Managing Director at Rosenblatt Securities. Barton, happy holidays. Great to have you on board.
Yeah, thank you. Happy holidays to you, Frank.
All right. So, Bart, I just want to be clear. $680 price target. You're not even the lowest on the street, but $680. The stock's trading at right around $930 right now. I don't imagine that your price target is hinging on the NFL game, but you're a little, or NFL games, but you're a little bearish on the company right now. So first question for you, do you think Netflix can pull it off?
Look, I think that this is a really big test. And look, they did really surprisingly well with the audience that they pulled in for this Tyson Paul fight. Over 100 million views globally, 35% share in prime time of 18 to 49, like half a Super Bowl, but twice a regular season NFL game in this country. So the question is, can they elevate sports that they carry generally like they did with this Tyson Paul fight? So, if we see explosive viewership for the NFL games tomorrow, beyond what we would have seen on television, then yeah, you have to really kind of rethink the story constructively. But if not, and I think my sense right now is it's more likely in this camp, if it's a little bit below television, then we're left with a story that has multiple vectors of slowdown. Last year, an explosive year in margin growth, an explosive year in subscriber growth. The upcoming year likely to decelerate a bit from that.
So, Brian, I do have to ask you, didn't Netflix kind of juice it a little bit? I mean, you have Mariah Carey performing. You also have Beyonce performing. Doesn't that kind of change it from just a regular NFL game? I mean, I would imagine those two personalities alone are going to bring in a lot of viewers. So is this quite the make or break moment that a lot of us are kind of positioning it to be?
Yeah, look, I mean, you're right. If those celebrities make this, a different game, sure. And it's TBD. My sense right now is that there's a lot of people that don't even know the NFL is on Netflix on Christmas Day. And they'll have to battle through that. People are used to kind of turning on television if they want to watch football. So we'll see how they're able to transition to the new distribution and the awareness. But we'll find out. I mean, this is a real moment for them. If they can do it, if they can, shatter the viewership expectations again, then it's a different mousetrap and a better mousetrap for sports.
Right.
And that's a real challenge for TV and very constructive for Netflix.
So, Barton, walk me through your price target. Again, 680, stocks at about 930. Co-CEO Ted Sarandos has said people like live events, so they're doing more live events. People don't like technical glitches, so that's obviously one issue they have to face. But in general, they're bringing more live events. They're also bringing a lot of really popular things like wrestling on board. What's going to lead this stock to basically crater, to go from 930 to 680?
Yeah, look, I mean, we're arguing that this should be a stock that trades at close to a 30 PE. Right now, it's trading at about a 46 PE. We think that earnings per share growth is kind of normalized in the 20% range, which is supportive of a little bit of a premium, but not the kind of 2x premium that we're seeing right now. So, look, part of it is that they've had a big lift in subscriber growth from the end of paid sharing. That has to come to an end. And part of it is that the ad ramp will take time to accelerate. Sports is part of the story, but they're also competing in a market that's really pivoting from brand towards performance. They're good in brand. They're evolving, basically emerging in performance. And there's some really good players out there that are better positioned than Netflix for performance, like Amazon, where they can connect you to the checkout cart. So, I do think that we're not going to see the same growth going forward that we have seen. And I think that's an argument for the multiple to pull in. But the sports thing is a real transformative test. If they can beat my expectations again, a lot of it's going to be anchored on what they do with sports near term.
Let me ask you a question about the broader streaming space. I had a guest on my show, Worldwide Exchange, earlier today. They had an estimate. They say to watch every NFL game, it would take 7 different streaming services and cost you about $1,500 annually. So with that kind of cost right there, I would imagine that there might be some people deciding I only want 6 streaming services, maybe I only want 5. Who benefits as we see this push for live events and sports and all these streaming services? Let's take it beyond the NFL. Who benefits as we see this fragmentation in streaming and live events? Who gets hurt?
Yeah, look, I think that over time, sports will migrate to the strongest business platforms. And over time, that is going to be the tech giants. So it's going to be people like Amazon. That's going to be people like Alphabet, Google. That's going to be people like Apple, Netflix potentially in that mix, Disney, potentially in that mix. But people have other businesses that they can attach sports to. I think that the TV bundle is going to be the loser over time. I think this idea of a sports floor is going to be challenged as we see more things like FIFA World Cup, Women's World Cup moving to Netflix, things like the NBA moving from Turner to Amazon. As you lose those big sports anchors, the TV bundle is going to be a source of economic value for the big streamers and big tech platforms.
So I understand you're saying there's going to be some cord cutting, but certainly out of all these big streamers, somebody has to lose out. I mean, I know I'm not going to buy 7 different services. I have the Sunday ticket. I can see the games I can see. I have Netflix. I can see those games, but I'm not buying everything.
Yeah, you're not buying everything. There will be, a range of outcomes. Some people will subscribe to more services perhaps than you. But clearly, scale matters. And clearly, it's very challenging for those at the low end of the scale spectrum. So we wonder about, some of the streamers attached to the big media conglomerates, like a Paramount Plus and others. And, and then, at the other end of the spectrum, people like in Amazon seem really, really well positioned, with so many things that they have going on to drive value through their video platform.
All right, Barton Crockett of Rosenblatt. Your price target on Netflix, it is $680. Stock trading about $930 right now. Really appreciate your time and your insight. Have a great holiday.
Great, thank you.
Coming up here on The Exchange, setting the table for 2025. It was kind of a mixed bag for restaurant stocks this year. You had names like Chipotle bringing in the guac, while others like Starbucks, well, they just couldn't find the right jolt. We'll take a look at how the group will hold up next year, especially if consumers further tighten their belts. The Exchange. We'll be right back. And welcome back to the exchange. Quick check of the markets right now. The Dow off of its highs of the day, still up just about 200 points right now. Also, we're seeing the S&P move up just about 0.75%. The Nasdaq also moving higher, up almost 1%. The tech sector on pace to close at a new record today, right here on Christmas Eve. We're also looking at Tesla, a key climber today. This comes after that name, along with Meta and Broadcom, saw its weights shrink in a Nasdaq 100 rebalance, due in large part to the unprecedented swell in their stock sizes. Taking a look at Tesla shares right now, up over 4.5%. Now let's get to our Seema Modi for a CNBC News update. Happy holidays, Seema. Good to see you.
Hello, Frank. Here's a news update at this hour. President-elect Donald Trump said today he will direct his Justice Department to vigorously pursue the death penalty when he assumes office on January 20th. The statement comes just one day after President Biden commuted the sentences of 37 out of the 30 federal inmates on death row. Pre-construction work to design a new Francis Scott Key Bridge in Baltimore will reportedly begin early in the new year. Contractors will conduct topographic and underwater surveys as well as soil sampling as early as January 7th. That's according to the Baltimore Sun. The first steps in rebuilding the bridge comes about 10 months after a container ship lost power and crashed into one of its supporting columns, causing it to collapse. And hundreds of visitors to the Eiffel Tower were evacuated today after a fire alarm malfunction on the elevator at the tourist attraction. The iconic landmark will progressively open later today, but with limited access to the top floors. Officials say visitors were never in danger despite initial fears of a fire at the monument. Frank, I'll send it back to you.
All right, Seema, thank you very much. Coming up here on the exchange, transport's having a rough end to the year, down around 10% in a month and nearly flat year to date. But our next guest says the economic backdrop, it looks good. So will transports hit the ground running in 2025? We will discuss that and much more when the exchange returns. Welcome back to the exchange. The Dow Transport's down nearly 9% over the past month, and there are several events that could put pressure on this broader group from here. There are potential strikes, tariffs, and the Lunar New Year all on deck coming up next month. But my next guest, bullish on the sector and sees several catalysts from here. For more on the catalyst and the concerns for transports in 2025, joining me is Don Broughton, managing partner at Broughton Capital. Don, good to see you.
Good to see you, Frank. How are you doing?
All right. So, Don, I know you keep your ear to the streets at all time. I was just talking to a big logistics and supply chain company. They said they're seeing a pull forward of freight, especially on the West Coast, where imports for containers were up 19% year over year in November. A lot of that's due to a potential strike and also tariffs. Containers are generally consumer goods, sneakers, laptops, et cetera. Is that all a pull forward of tariffs, or do you think something else might be behind that surge? Again, 19% at the West Coast ports in November.
Well, that certainly makes a nice narrative. But the truth of the matter is we saw this pull forward starting back in June and July, when it was uncertain as to whether or not who was actually going to be the Republican and Democratic candidates, quite frankly, as much less who was going to be the winner. And so I don't think it's that much as we'd like to make it. Far too often the truth is not as linear as our human brains would like it to be. We've seen this surge. In fact, if you look at the third quarter volumes we saw coming in, August, September, October volumes we saw coming into the ports, we saw as much as we saw at the previous peak back in 2022, where within 50,000 containers up. So I think that's more us looking for an answer where it doesn't exist.
All right, fair enough. You know, one way you look for answers when it comes to transports, the Dow Transports theory that you can read the moves in the Dow Transports to give you a read on the economy. Is that the case right now? We just mentioned transport's almost flat year to date.
Well, it's because the transports themselves are somewhat confused. You got to break the transports in order to get the real predictive value. You got to break the transports into people who move transports that move goods and transports that move people. Transports that move people don't predict anything, and it's really not the transports companies themselves that are somehow omniscient or prescient. What really tells the future is the goods that they're moving, and so those, if you move more goods, these are asset intensive companies. You see higher asset utilization, and so you see higher margin, which gets you higher earnings, which gets you higher stock price. So it's the goods, it's the underlying goods flow that predicts what's going on in the economy, not the stocks that are somehow omniscient or prescient.
So then, Don, read these tea leaves for me. I'm looking at the chart of FedEx. Last week, they had the spinoff of their freight business, an LTL trucking business. Stock popped big. Then the next day, I believe it actually closed lower. I'm looking since that announcement, down 1.5%. Also, the rest of the companies in that LTL sector, names like an XPO, an Old Dominion, Asaya, all of them are trading lower. They move goods. The freight spinoff is supposed to be good for the overall industry. What's going on?
No, first of all, they think this freight spinoff is a good idea, but then they also announced that it's going to take them 18 months to spin it off. So then everybody's excitement grew cold, because nobody on Wall Street likes to wait 18 months for anything, first of all. And second of all, if you're going to spout off what the price of XPO is going to be, or Old Dominion, or any of this, tell me what those stocks were a year ago, 2 years ago. I mean, 2 years ago, XPO was a $45 stock, and now it's $155 stock. So we've come a long way. If you look at the volumes of inbound containers, if you look at the volumes of Asia Pacific, in particular air freight, which tells us that the tech boom is indeed intact, then you get much more bullish about the overall economy.
All right. I know you're bullish about the overall economy, you're bullish about transports, but coming up in January, we have a couple of events that have the potential to create one of the biggest supply chain crises that we've seen since the pandemic. We got to keep it in perspective. I don't think there'll be anything like the pandemic ever again. But
let's hope not.
Seriously, let's hope not. Potential strike at the East and the Gulf ports. We have possibly tariffs starting on Inauguration Day. And then we have Lunar New Year much earlier than normal. It starts on January the 29th. Normally, there's a pull forward of freight, as we mentioned earlier, about 2 weeks ahead of time. If you just do the math here, this could create a big logjam, especially at those West Coast ports. For investors, how should they view the possibility of all this happening?
Well, let's walk through those one at a time. First of all, the tariffs are terrible taxes. And I think Trump understands that. But what I think he also understands is that there's a lot of progress that could be made in trade agreements through bravado and posturing. I mean, let's face it. If you go back to this, differ with all those who say we don't know what we're going to get this time. You just don't know what he's going to do. Well, yeah, actually, we do know what he's going to do. We've seen 4 years of this before, and people say, oh, well, there's going to be these horrible 50%, 80% tariffs, and it's like, well, no. I believe that we're going to get those kinds of trade stopping tariffs when the Mexicans finish building the wall they're going to pay for. Right? He makes these threats, but they're negotiations. They're not. They may sound like ultimatums, but they're just simply negotiations. So before we say that that's going to be the tariff we have to deal with, let's just see what actually happens. One. Two, we have the timing of the Chinese New Year fluctuates back and forth every year. And, what it ends up normally being, in this case, a very early one means we have a more heavily weighted February, is really what it normally ends up being. And the strikes, well, we've already seen a shift back towards the West Coast ports as a result of the threat just in the last few months. I think that shift continues until the East Coast labor is settled. It's like many things. This too will pass, but the overall volumes are up.
All right, Don Broughton, straightening people out right now. A little sarcasm about the wall and an optimistic outlook of trifecta. Don, great to see you. Have a good holiday.
Always a pleasure. Hey.
All right, going up here on the exchange, investors will be carefully watching this week to see if a Santa Claus rally comes to Wall Street. Right now, stocks are heading higher with the NASDAQ once again leading the way. Coming up, we'll look at some of the individual names that are on the move. Stay with us.
Inside Wealth.
Welcome back to the exchange. Taking a look at the markets right now. We are at session highs right now. You can see the Dow up over 250 points. The S&P also up over 0.75%. The Nasdaq, the best performer on a percentage basis, up over 1%. The Russell also up about 0.5%. Back to the S&P, reclaiming that 6,000 level. The Nasdaq just shy of 20K. Here are some movers this hour. We're going to start with Apple. The stock continuing its steady climb, hitting a new all-time high today, up 11% over the past month. And that market cap is getting closer and closer to $4 trillion. The number to watch there, $264.62. Palantir, another stock continuing a strong recent run. It's up nearly 400% this year. Look at that chart, up over 1.5% today. But, and it's a big but, only 3 of the 20 analysts covering the stock give it a buy or a strong buy rating. The average price target of Palantir also just about half of where the stock is right now. We're also looking at Bitcoin rising today, bringing back the miners and other Bitcoin-related names, MicroStrategy, of course, but also Hut 8, Marathon, and Riot, all of them gaining. You see Marathon up just about 4.5%. You see Riot's up over 6%. And if Bitcoin just isn't volatile enough for you, check out quantum computing stocks. Today, Rigetti Computing, one of the most actively traded names. You see that stock's up over 6.5%. The stock actually bouncing back big time after its post-Fed drop last week. It's up more than 50% in the last 3 sessions and up over, this is correct, 600% over the last month. Also one of the top holdings in the QTUM quantum computing ETF. If you're looking for a broader way to play it. All right, coming up, some food for thought. In a banner year for the markets dominated by tech stocks, McDonald's and Starbucks, they're both lower for 2024. Should you bet on a turnaround in those names next year? We're going to talk about it. The exchange coming up right after this break.
Can save.
Welcome back to the exchange. Shares of McDonald's are up nearly 12% over the past 6 months. And my next guest thinks the biggest, they may get even bigger in 2025 with the launch of the company's new value menu coming in January. Joining me now to discuss why he named McDonald's a top pick and a look at the rest of his restaurants stocks that he covers. Andy Barish, Managing Director of Equity Research at Jefferies. Andy, great to have you here.
Hi, Frank. Thanks for having me.
All right, why don't we start with it? McDonald's. Why is this value menu so important for McDonald's? We keep talking about the strong consumer, the strong economy. Why are cheaper menu items so important for this name?
Yeah, it really goes back to the lower end consumer, kind of that under $50,000 a year household that does continue to struggle. And McDonald's probably, along with a lot of the other quick service restaurant brands, over indexes to that lower end consumer. So giving that consumer reasons to come back, driving frequency is of paramount importance in terms of regaining share and moving with some momentum into 2025.
All right. By the way, your price target for McDonald's is $3.45. You also have it at a buy right now. What about the rest of the restaurant space? What are you expecting when it comes to same-store sales, a key metric when it comes to the broader restaurant space? And we said you think the big are going to get bigger. Does that mean these big chain restaurants, whether it's quick service or fast casual, those are going to be the beneficiaries?
It seems that way. That's the way 24 was. We think 25 will kind of be a normal year. You're right. This is probably the first year in a couple where we're not debating about recession or not. The consumer overall does appear to be healthy. The holidays are rolling along very nicely. And we think it's going to be a year where same-store sales are up probably 2-3%. Traffic in the industry is kind of flat to slightly negative, which is not that different than what we saw in the decade leading up to COVID. And the promotions continue to be fairly sharp, which tends to bode well for those that are everyday value leaders and can offer a great value, whether that's price, whether that's experience, or a combination of a number of factors. Obviously, we mentioned McDonald's. There are some other big companies that have been doing a good job. We're at Hold On, Chipotle, Texas Roadhouse, that are driving same-store sales and traffic.
Okay.
We think one of the smaller growth companies that's inflected positive is Dutch Bros in the coffee category, drive-through beverage category. That should have a really nice 2025 as well.
Also, it's what we're talking about, the companies you like. Cheesecake you like as well, First Watch as well. I want to get some of the names that you don't actually like. One of them is Starbucks. Now, this seems a little bit contrarian when we look at the rest of your thesis. You like big chains. Starbucks certainly a big chain. It has a lot of stickiness when it comes to customer loyalty. Why are you down on this name?
Yeah, for sure. We're the only underperform on the stock, and it's nothing to do with Brian Niccol and the management change they made earlier this year. It was just that it added so much value to the stock at the time that we thought the value of the equity had gotten way ahead of the turnaround, which we believe will take some fairly significant time and energy from Brian as he puts together his team and then works into 2025 to stabilize the foundation and the culture of the business. So, yes, a great brand that will come back again. We just think it'll take a little bit longer and be a little bit bumpier than the market expected when the stock rebounded with Brian Niccol's announcement as the new CEO.
All right, Starbucks shares up just about 2.5%. By the way, I never really thought oil and coffee made a lot of sense, but that's just a side note. I want to get to one other area that you're very bullish on. It's food distribution companies. Not something we talk a lot about here on CNBC. Very quickly, what's your thesis? Why are you so bullish? What's the top pick in that space?
Yeah, they're really covered primarily by my colleague Alex Slagle, who has done the work on that category. And the thesis is, even with negative traffic in the restaurant segment, the food distribution category is so fragmented that the big three of Cisco, Performance Food, and U.S. Food can continue to gain share and grow cases. Also, the inflationary environment with kind of low single-digit inflation is sort of a perfect setup for their business models, and they're very stable business models with nice share opportunities. We like all three. Cisco's the big cap name. U.S. Food has been the best performer, so the focus probably going into 2025 to make up some ground is Performance Food Group, PFGC.
Okay. Look at those shares up over 0.5% right now. Andy Barish, Jefferies Managing Director of Equity Research. Great to have you. Thank you very much.
Thanks.
All right, one more quick look at the markets before we let you go. Markets very close to their session highs right now, and that's going to do it for the exchange. With only an hour left in this shortened trading day, closing bell with Scott Wapner. It is going to start right after this break. You have a great holiday.
Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. We're an hour away from the close on this holiday shortened trading day. Stocks higher on this Christmas Eve, the day when the so-called Santa Claus rally is officially supposed to begin. Apparently, it is. Yields, they're higher today. The market games out the Fed's next move. Nonetheless, stocks are withstanding that for the moment. We are on Apple 4 trillion watch as well. The stock on a tear lately. It needs to reach $264 to hit that milestone. We will follow that and have a special report coming up as well. All of the other large cap tech names higher as well. You take a look there. Microsoft top of your screen. Meta up near 1%, now north of $600. Does take us to our talk of the tape. The bull market, which keeps on chugging. So how far can it really run? Let's ask Dan Greenhouse, Solus Alternative Asset Management's chief strategist, with me here at Post 9. Welcome back.
Thank you,
to see you, and happy holidays to you.
Merry Christmas to you, and happy holidays as well.
You're pretty optimistic still about next year, right?
Yep, I am. Listen. We had a terrific run all year, a terrific run off the summer, off the October lows. Some give back into the end of the year was not what I expected. In previous shows, I talked about going out of the year at somewhere around 6,200. That obviously will not be the case, or presumably will not be the case. So I'm a little surprised, but in the context of what's happened, I don't think it's that big of a deal, and thus far doesn't really change my outlook for next year.
So what were you thinking was going to happen that didn't? Like, why do you think we're going to disappoint your high expectations to finish the year?
I thought, that, not obviously, but it seems like a lot of this has to do with the Fed meeting and the adjustment in interest rates, and the Fed seemingly suggesting
the hawkish cut.
The hawkish cut, if you will. That's right. And I thought that the market would have known that to be the case. And obviously it was not. I mean, obviously futures pricing was already looking for somewhere around 2 cuts next year instead of the 4 that we've been talking about for much of the year. And so the adjustments since then admittedly caught me by surprise. I don't think it's new news per se, and perhaps maybe the market is overdoing it a bit, but it does appear that the market wasn't as prepared for it as I thought.
The backup in rates, right? That's partly what we're talking about here. Because the Fed was more hawkish, the outlook is a little more hawkish. They're going to cut, but obviously less than we thought. Rates have backed up significantly from September when they did the jumbo cut, right? But if they're going up for the right reason, is that okay?
Yeah, listen, I think so, and that's been my position for many years now. This idea that let's just, I mean, to boil it down to the core of the issue here, it's not going up. The yields are not going up because there is some inflationary outbreak. There's obviously a concern about incoming president, former president, soon-to-be President Trump's policies, and whether that's meaningfully inflationary. That's a separate conversation. I'm not so sure it is.
Is it a separate conversation? I mean, that seems to be what the market and, frankly, what the Fed are both trying to figure out. I mean, the Fed has said as much, right? They don't really know what the impact of prospective tariffs are going to be.
Some Fed officials did seem to incorporate President Trump's policies into their forecast. They're trying to assess it. Listen, my view on this is twofold. One, taken on its own, tariffs are inflationary, for lack of a better word. However, there are other mechanisms in place here. Demand can shift. Which is presumably what obviously the goal of the tariffs are to do. You can have a currency adjustment, which perhaps mitigates some of the negative effects on prices with respect to tariffs. And I would also add, when you look back, and I'm a dead horse, but when you look back at the previous period of tariffs, yes, goods prices adjusted, but headline prices did not. And I think too many people say, well, there was no effect on prices because the headline number was down. It is true to say core goods prices, which had been declining for many, many years, ceased doing so, and actually...
But it's different this time, right? Because you're starting from a base of higher inflation than you were then.
So, without a doubt.
And higher prices, let's be honest here, right?
Well, of course.
That's the bigger story anyway.
That is right. But I would also add a stated goal of incoming President Trump is to lower oil prices. And to the extent that, and listen, oil prices have already been coming down. Prices at the pump, gasoline prices, I haven't looked in a couple days, but last I looked were somewhere around $3 a gallon. Not great, but not terrible either. If you can somehow engender higher oil production, either domestically or more likely overseas, you can start to put some downward pressure on oil prices, which presumably would help out on the inflation front. So I'm not as universally negative as a lot of other people on the tariff side of things.
You say the consumer's fine.
Yep.
And you expect positive fundamentals to reassert themselves. The positive fundamentals being what? And how do they need to be reasserted if we already have positive fundamentals is one of the reasons why we're
rallying, and we may have started another one here as the Santa Claus rally is beginning today.
That's right. So let's address those one by one, the consumer and then the fundamentals. Okay. On the consumer side of things, Darden just reported, Olive Garden, Longhorn Steakhouse, Chuy's, Yard House, a mall-based, anyone who's been in a mall knows Yard House. Darden had pretty good things to say about the consumer. That's our latest fundamental bottom-up look at consumer spending. Obviously, we've got tons of macro data that corroborate that. Everyone talks about the retailers. We know Walmart and Costco, but the retailers in general, I prefer, with respect to the consumer conversation, to look at American Express, Visa, MasterCard, Capital One. All those stocks are doing pretty well. The commentary continues to be pretty strong about the consumer, and we know what's going on with the labor market. Mm-hmm. So I'm not at all worried about the consumer through the vantage points of which I view things. The fundamentals reasserting themselves, I'm saying right now the narrative that we have on the network and in these conversations is largely focused around the Fed and yields. And that is the dominant narrative right now. What I'm arguing is when the calendar turns and we start getting additional data and then eventually earnings season, those fundamentals, which I still perceive to be quite strong, are going to become part of the narrative, not the dominant part of the narrative. And we can move on from the Torsten Slot conversation about hiking rates.
Right, the 40% chance that he
That's
gives.
Right.
The 40% chance he gives to the 10-year going to 5%.
Yeah. By the way, I would put a higher probability on the 10-year going to 5% than I would on the Fed actually hiking rates next year. I think they're two different things, although they're related. Torsten's obviously phenomenal. I have great respect for him personally and professionally. I'm not so sure that they're hiking rates next year. My point is just that's become the conversation as opposed to the fundamentals driving stock prices higher.
What happens if the 10-year does rise above 5%? What happens if he's the 40% actually happens? The probability 40% comes to fruition.
I think it's probably going to be a little tricky for stock prices in the short term. Obviously, the 10 years now, we call it 460. We're certainly
north of that, right? I mean, the rates are up again today, by the way, as we said at the outset. There's 461.
Yep, 461.1. We need that extra decimal to
we do. We always do.
So the bias is clearly higher for yields right now. It feels like momentum wants to go higher into the 475 area. I'm not making that call. I'm just saying that's what it feels like.
And that would be tricky.
I think it would probably, listen, we saw this once already when we whisper touched 5% a couple of months ago. If we put up a longer term chart of the 10-year, you can see we did tick 5%. And it was a little tricky for stocks. And then as soon as yields started coming off their highs, that coincided pretty much with the bottom in stocks, as we know. And I think it's not unlikely that something like that happens again.
We're back to a more top-heavy move in the market, right? This latest leg of the rally has been more top-heavy. NASDAQ is up 1% today. We're looking at a record high for the tech space. Apple's at a record high. A lot of these other names have been rallying as well. Is that story going to change anytime soon?
Yeah, I go back and forth. At the beginning of the year, I was one of the people who said, no, you're going to make your money elsewhere. That proved for much of the year not to be the case. Solus, as a hedge fund, as an investor, are looking for the non-Mag 7 type investments. We own a number of companies in energy and consumer, in a number of areas, in crypto adjacent, that are good fundamental stories that are doing quite well, although you have to give credence to the fact that Apple and Broadcom, Tesla, Netflix, those types of large tech, although Netflix has consumer, obviously, touch points, as does, I guess, both Tesla and Apple. Those large mega cap names are doing phenomenally well. And I know you've had conversations like with Rob Sechin and the halftime crew about the earnings growth really slowing down for those names and what that portends. My hope is that the broadening out that to some degree has happened continues because of that slowing earnings growth. And I don't know that I don't like grouping the 493 together because I think that's too broad. But I think there are clearly stories here. Again, I mentioned on the consumer side of things in particular that investors can find fundamentally attractive, even if those larger names continue to do well.
The other thing that Apple is doing, it's closing in on $4 trillion in market cap. It needs about $7 of share price to get there. 264 and change is what we're talking about to get to that milestone. Steve Kovac joining us now with a look at what's driving this recent rally. It's really taken off since we sat together at WWDC. We've said that so many times. On the expectation and excitement around AI and an upgrade cycle that really has yet to come to fruition, which is what makes this move all the more remarkable. Yeah, that's exactly it, Scott. It's kind of melting up. And let me give you the magic number, though, to look out for. Like you said, $264 to be more specific, $264, and let's call it 63 cents if we're going to round up there. And look, the holidays are kind of a moment for reflection, so it's worth taking some time to look back, like you mentioned, Scott, how Apple started out the year. It was vastly underperforming its peers, Microsoft, Meta, Amazon, Alphabet. All of them, they had AI stories to tell investors, even if they weren't really seeing sales from that story quite yet. Apple was late to reveal its plans, at least a year late, but all it had to do was show off Apple Intelligence back in June at WWDC to get the stock positive again for the year and on its way to the $4 trillion market cap we're talking about now. Also helping, of course, that record-breaking buyback, $110 billion. That probably helped a little bit, too. Now we see shares are up 33% on the year. It's been just quite a turnaround. But I'm always looking at the next step, and we have to see how Apple's AI story, whether or not it can prove itself out and drive sales growth. We just really haven't seen much evidence of that yet. We talked to so many analysts on this program who just say that it's going to be a kind of lackluster season here for the iPhone, maybe a little bit of growth in the single-digit percentages, but we really won't know for sure until we get through this December quarter and hear from earnings. But before that, though, something else I'm watching that could impact the stock, and that is President-elect Trump's proposed tariffs that he has promised, sweeping across the board, especially in China, where Apple makes most of its products and it imports to the United States. Apple would be one of the worst-hit companies if that does actually happen. What case does Tim Cook make to President-elect Trump to convince him he deserves an exception for Apple from those tariffs yet again, Scott?
Yeah, it's been really a leap of faith move in the stock, right? Looking forward to what might be and what hopefully will be rather than what is today. And then we're going to have to wait and see. I mean, the first earnings report of 25 is going to be critical.
Yeah, and that's exactly it. And I guarantee you, when I sit down with Tim Cook and have a discussion on those results, one of the things I'm going to be asking is, what evidence are you seeing of sales growth from artificial intelligence? That's the question on everyone's mind. We did not get a clear answer from Apple on that last earnings, only because the period we were talking about then only represented a week and change of iPhone 16 sales, so there wasn't really enough data to go on. We're going to have that data now. We're going to have a full quarter of iPhone 16 sales to really see if this narrative is playing out, or if we do see some sales growth. Is it just because people needed new phones? We're in that cycle after so many years of people hanging onto their phones. The last big cycle we saw was when 5G hit about 4 years ago, Scott.
All right, good stuff, Steve. Thank you. As always, Steve Kovac. Let's bring in Adam Parker now of Trivariate Research and Sandra Cho of Point Wealth Capital Management. Adam, a CNBC contributor. It's great to see you both. Happy holidays. Sandra, I'll go to you first.
Happy holidays to you.
You do like tech. Do you think it's going to have a great year, or how would you characterize the kinds of returns that you see in 25?
So yes, I mean, tech has had a really great run, and we do see that continuing into 2025. We like certain names. We're looking at Taiwan Semiconductor and Palantir. Tech has a hold on America with AI, and you can see from Apple, which you just spoke about, with their launch of the iPhone 16 and the platform, the iOS 18.1 free upgrade that they have. I have 5 kids, yes, a plethora of kids, and 2 of them are getting an iPhone 16. So if that's an indication of the broad, market as far as iPhone 16 growth, it's pretty good.
Adam, 33% year-to-date gain for NASDAQ. What do you think's reasonable to assume for next year?
Less than that, but it's hard to be, directionally positive on the equity market and not be at least market weight tech. We've talked many times, Scott, you have to own the big names. I don't make that big of a deal out of Apple being $4 trillion. All that means is it started the year big and it's up the same amount as the NASDAQ and actually less than all the other Mag 7 except for maybe Microsoft. So I don't think the $4 trillion matters. What I think matters is, do you get any proof cases from big companies in the first half of the year that they're driving margin expansion by basically saying, hey, we used analytics in a way we didn't in the past. If you get that from a Walmart or a McKesson or some big company, you'll get another big leg up in these tech stocks.
Sandra, it underscores really, as these stocks have moved up, as we said at the outset, the market's gotten a little top heavy. It's also exposed breadth in the market that recently has been terrible. right? We went through a 14-day or so stretch where you had more down stocks than up. And the ones that were up were largely mega caps. They're so big by market cap that you can still carry the S&P 500 and the NASDAQ by doing that. But do you see that as a sign of weakness to think about or be concerned about?
So I'm not concerned about that because if you look at the slight rotation that there's been in 2024, you look at the Mag 7 and there's only one name, NVIDIA, that is still in the top 10% of stock market growth in 2024. We do think that there is going to be more broad market participation next year. And as a result, we are more equal weighted than large cap growth weighted, for example. And we do think also, and we've been seeing it, that there's more participation in the smaller and mid cap, and we are definitely more pro mid cap than we have been of late.
We started, Adam, Dan and I did, by talking about the Fed and the market's uneasiness with what may happen next year, fewer rate cuts. Maybe we'll have inflationary policies out of the new administration. We just really don't know. You ask several questions heading into the new year, one of which is, when is it time to fight the Fed? Why do you ask that, and what are you thinking the answer is going to be?
Well, I think we learned toward the end of 2022, when they were still hiking, that you could say, wait a minute, they're closer to being done hiking than starting, and we can be bullish again, right? And that's why you really look back. The last trading days 2 years ago right now, it seems crazy, but Meta and NVIDIA were both down over 60%. They're huge amounts in 2022, and you had to buy them immediately on Jan 1 23. So the question will be, are we are we halfway done or a little bit more than halfway done? Then maybe we can't be as bullish, and we think about all the things that make us bullish. Maybe that piece of that leg of the stool is a little bit more challenged now because we're probably halfway done with this interest rate cycle. And so I think it's soon. I think the answer is in the first half of this year, you'll no longer be able to say, first half of 2025, you'll no longer be able to say that the Fed accommodation is one of your bullish points. On the breadth thing, Scott, look, I kind of disagree with how people describe that. I was just looking down at my notes. 71 stocks in the S&P 500 are up 40% or more this year. 119 are up 30% or more. And 77 stocks are down 15% or more. I don't know if you can get a better breadth and a better stock picking environment than you had in 2024. I expect it to be tougher to pick winners from losers next year than it was in 24.
Yeah, on the breadth thing, I think Adam's right. Listen, the stats are the stats, so Adam's obviously right about that. I think the breadth concern that someone like I might have, if either Adam or I were back at our sell-side strategist days, I might say, well, listen, the S&P is up 30% for the year. I'm rounding. To Adam's point, only 119 stocks have outperformed. You'd expect that to be much more 250, 250, 260, 240, something like that, than quote-unquote just 119. And I've done the work before about previous years that are up similarly, and you've seen something more along those lines. Mm-hmm. I don't think Adam's wrong. I just think if you're a stock picker, I agree with Adam. There's a lot of variation and variability here, but I would have expected more stocks to be up, and which speaks to the concentration. Which speaks to the concentration of those large stocks and the work that they're doing.
You wanted to address his idea of when it's time to fight the Fed, right? If we find out, I think we are finding out, and the process of dealing with that the Fed's going to be less accommodative in the new year. At what point is that a problem for stocks, if at all? Maybe we don't need the Fed to be as accommodative as we once thought because the economy is more resilient than we expected.
I don't think so. And I'm sure Adam agrees. Narratively speaking, the Federal Reserve does a lot of heavy lifting. Well, the Fed's cutting, that's good. The Fed's raising rates, that's bad. And obviously, some points are better than others for each of those arguments. But we are, to the point, expecting, I don't know, it's going to be 9 to 15% earnings growth next year, something like that, assuming the economy unfolds the way that the consensus expects.
I think we're, north of 14% is the expectation.
Yeah, something Joe mentioned on yesterday, I think it was, whatever he was looking at was at 14.4. The Bloomberg consensus is at like 12, whatever the number is, it's somewhere in that range. If the Fed pauses, so to speak, for the right reasons, inflation is not going up, but it's not coming down per se. At a baseline, you're starting with an expectation for something like 10% stock appreciation next year, assuming the multiple doesn't contract. And if you're going to make the argument that you're not going to get 10% appreciation, let's say, then you've got to explain to me why the multiple is going to contract. And I think if the economy unfolds the way that I expect it to, and largely speaking the way that the consensus does, I don't know. I don't think it's far-fetched to expect something like 6,800 to 7,000 next year. I don't think that's egregious.
Sandra, I don't feel like you're looking for great returns next year, right? Mid-single digits, maybe low double digit. I mean, I guess that would sound like a great year relative to what we've done, but not relative, obviously, to what we've done the past couple of years, where, we feel like, well, I mean, we do 20%, 25, 30%. That's great back-to-back years.
Yes, I mean, we're definitely looking for moderate growth next year. But, look, if profit margin expansion happens, then we're looking at, higher double digits. So it really is going to depend. And, to what everyone is saying about, inflation and whatnot, I think that we have yet to see the market really kind of digest where inflation is going to be headed in 2025. There's a lot of question marks, right? So whether it be the Trump trade and inflation, ticking up a bit or really moderating, leveling off. At the end of the day, if the Fed, like we expect, lowers interest rates, by three times by 75 basis points, then and the market believes that it's still trending down, then, that's going to bode well for the market and for fixed income. So, and you look at right now, you look at shelter costs coming down as a share of CPI. You look at, wage growth actually going down, and job growth cooling. So you really do see that inflation, all the boxes that have to be ticked off in order for inflation to come down, that's happening. And that could really bolster the market.
Adam, what's your best buy idea to finish this year and this conversation?
Well, Scott, it's probably you. You're my buy idea.
Okay.
I love your program.
Wow.
But, honestly, I think it's healthcare.
Are you pandering, trying to get healthcare
Are you upset because you're remote today and not on set?
Yeah. I really mean it. It's been a great year being on your program. I think the answer to your question is healthcare.
The producers are
everyone
throwing
hates
up
it
in the control room as we speak.
That's out of envy. I think for healthcare, the estimate achievability looks to me above average. It's the one area of the market where everyone believes the Trump policies will be, as he states them, immediately implemented and destroying a lot of the earnings. Yet nobody's really worried about the earnings being implemented by other parts of the policies. So it feels to me like sentiment's negative. I love healthcare services in particular, McKesson, Cencora, Cardinal. I think that theme works. And I think if they show some, I love these businesses, Scott, that have high revenue, $350 billion revenue, low margin, and they can just show a little bit of progress on margin, then they get the multiple expansion. So I think there's a ton of things to own. We do our outlook on January 6th, so I'll look forward to be, buttering you up and getting back on your program right after that.
All right. We can't wait. Let me tell you. Adam, thanks. Sandra,
good to see you guys.
Happy holidays, everybody. Dan Greenhouse, thanks for being here.
Happy holidays.
All right. So Pippa Stevens now for a look at the biggest names moving into this short and trading close. Pippa.
Hey, Scott. Well, shares of American Airlines recovering their earlier losses after the FAA issued ground stop that halted travel for all the carrier's flights was lifted this morning. Americans saying in a statement it was due to a vendor technical issue, but that all flights have resumed and there were no cancellations related to the issue. And shares of ServiceNow moving higher after analysts at Raymond James initiated the stock with an outperform rating and a price target of $1,200. The firm said the software platform deserves an elite valuation given its rare blend of both high revenue growth and free cash flow. Scott?
All right, Pippa. Thank you, Pippa Stevens. We're also keeping an eye on the banks today as some of the industry's biggest names are now suing the Fed over its stress tests. Steve Leisman has those details in what was a pretty interesting development this morning, Steve.
Yeah, Scott, the biggest banks are suing the Fed, contending that the bank stress tests violate the law, even though those stress tests are, in fact, mandated by a law, the Dodd-Frank Act of 2010. The way they're administered, created, and judged, along with the resulting decisions the Fed makes about bank capital levels, they are not. They're the product of decisions made by the Fed to implement the law. The Fed yesterday conceded a lot of what the banks looked to be after. It said it would disclose the models used to evaluate the stress test, average the results over 2 years instead of one, and allow public comment on the scenarios themselves. But the Bank Policy Institute, an industry lobby group made up of the biggest banks, joined by others, sued anyway, preserving its right under the statute of limitations. The bigger story may be this. Business groups are emboldened to challenge industry regulation these days in the wake of the Supreme Court's June decision that overturned the Chevron precedent, which gave some deference to rulemaking agencies. That could be a good thing in the long run, reducing regulation and increasing transparency. The trouble for the stress tests is they're a test. Fed officials have worried for years about giving out the answers ahead of time, thinking the banks will just game the system. So an interesting conflict here, Scott.
Yeah, and it seems to be more about the process, right? The way the process itself is handled than necessarily the result of the test. Is that how you see this?
It is, Scott, but, hey, give me the answers. I'll tell you how, I'll ace the test every time. That's been the concern. That goes back to Dan Tarullo when he had this job. It continued even through Randy Quarles, who was more sympathetic to the banks, and it continues under Michael Barr. These are the vice chairs of bank supervision. So, look, I think the Fed is going to do this. And that means the stress test may be less meaningful, but also from the bank's perspective, less chaotic and might result in them needing less capital on hand, which these banks argue are extremely high.
Mm-hmm. Good stuff, Steve. Thank you, Steve Leisman.
Sure.
We're just getting started. Up next, Intelligent Alpha founder Doug Clinton is back with the tech names he says could outperform in 25. You might be surprised with who's not at the very top of his list. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC with the Dow Jones Industrial Average up 300 points with about 30 to go. Much like it has all year, NASDAQ is leading again today thanks to gains in Apple and the other mega caps. So how will these stocks do in 2025? Let's ask Doug Clinton of Intelligent Alpha and Deepwater Asset Management. Welcome back. Good to see you, man.
You too, Scott. Merry Christmas.
So Merry Christmas to you as well. Thank you. We did tease the fact that, the stock that you think may not be at the very top of the list next year, and it's NVIDIA. Not that you don't like it. You just think others may have their moment.
I do. I think if you look at the last 2 years, Scott, in terms of the AI trade, it was all about the hyperscalers spending billions of dollars on CapEx to build out really general purpose AI compute. So that was them investing in NVIDIA's top of the line chips to train the models, the AI models that they're building. I think as we go into 2025, that theme shifts to one of custom silicon. And the reason for that is now that all of these companies kind of have built out their general purpose infrastructure, I think they'll start to leverage a lot of the custom chips that they've already been building. So Google with TPUs, Microsoft, Meta, Amazon with Trainium, they all have their own custom silicon that they've been developing. And I think they're going to be more aggressive deploying that next year. And ultimately what that means is good for suppliers like Broadcom, who works with most of those companies. And it could be good for companies like Marvell as well, which is another stock we own at Intelligent Alpha.
Even so, what happens at the moment that NVIDIA fails to live up to the amazingly lofty expectations?
I think that if you look at just the AI trade relative to the .com trade, people often make parallels, and I think sometimes they're useful. And in this case, you look back to the .com era, Cisco, I think, was sort of the poster child. NVIDIA is our poster child today. And it is generally, I think, a barometer of just how people are thinking about the trade. And so what I think we could see happen is at some point next year, and again, NVIDIA is still a top holding for us, but at some point I think you could see NVIDIA maybe falter a little bit. And some of these other names, like a Broadcom or like a Marvell, might pick up a little bit more momentum. The sentiment then may be that, hey, the AI trade's over, NVIDIA is done and therefore it can't keep going. I think that would be a mistake, though, because the AI trade is not just about NVIDIA, it's about many other companies. And as it continues to evolve, I think we kind of broaden out and see more companies work just like NVIDIA has the last couple of years.
I mean, do higher rates hurt the growth trade, or do they just push people back to the biggest stocks in the market like they are right now?
I think it could push people back to the biggest stocks, but also I think it will push them to some of the AI players that have the most growth potential as well. So again, if you look back at that .com era, for most of the 90s, the interest rates were 5 to 7%. The 10-year was around 5 to 7%. So well within where we are today, in fact, a little bit higher. And so there's no rule that says we need low interest rates to have technological innovation happen at a great scale. But I think if you look at what are the companies that can push through potentially higher rates or persistently higher rates than we've seen for the last couple of years, certainly it could be the mega caps. They've already shown that they can do that. But I also think you could look at potentially some software names that start to get an AI bid. Snowflake is one example, again, another holding of ours that has talked more about an AI story. And I think companies like that who can say, hey, we do have a play in AI. We're on the software side. Customers are starting to deploy us for AI use cases. They might have a case to work next year, too.
What do you like most outside of tech? We always identify you as a tech investor, and I feel like 99% of our conversations are about that sector and those stocks. What do you like outside of there?
It's certainly where I spend most of my time. But at Intelligent Alpha, we do use AI to look much more broadly than just tech. And one contrarian idea that AI has been on for the last several months, it hasn't really worked out so far, has been the energy trade. And in using our AI models to make predictions going into 2025, one prediction that AI has made is you could see oil hit $100 a barrel. I don't think anybody has that on their roadmap, and so it's certainly contrarian. If it happens, I think the oil trade or the energy trade in general probably works in a big way. But stocks like GE Vernova, not dependent entirely on oil, but I think in terms of infrastructure build out, green energy will continue to be a theme, and then Schlumberger are two that are larger holdings in our portfolio currently.
All right. Doug, thanks again. Merry Christmas. We'll see you soon. Doug Clinton.
Thanks, Scott.
All right, up next, break out the neck brace. Ed Yardeni is making the case for a volatile start to the new year. He is sizing up the rally's road ahead when we come back. All right, welcome back. Our next guest, bullish stocks in 2025, which is really nothing new. Ed Yardeni is the president of Yardeni Research and joins me now. We kid, of course, but it is true. You are a so-called perma bull, unapologetically so. I might add. Is that right?
That's correct. I think, if you look at the market since World War II, if you stayed in the market, you would have been wrong 14% of the time, maybe. It's been a bull market for quite a long time, and I've tended to counter the perma bears, looking for some balance anyways.
Well, you've done it well. So why do you think this is going to continue for a while?
Well, I think that we just, over the past 3 years, had the most widely anticipated recession ever that didn't happen. It was the Godot recession, the no-show recession, and it kind of made sense that to a lot of people that it should happen because interest rates went up so much. But if we couldn't get a recession over the past 3 years with the Fed tightening, I think the outlook remains pretty optimistic for the economy. And on top of that, we're expecting to see productivity make a significant comeback here. It's already made a significant comeback. We think it's going to continue to grow, maybe 2.5% to 3%, which is pure gravy for the economy, for economic growth, keeps inflation down. It's great for corporate profitability, and it keeps wages rising faster than prices. All good.
I mean, essentially, you think the debate over higher interest rates or higher for longer or a slower Fed is overrated, that we don't even need the rate cuts that
Correct.
some suggest we can't live without.
Yeah, I think the economy over the past 3 years has demonstrated that it's resilient, that it can live with these interest rates, and that these interest rates may actually be normal. I mean, I recognize the Fed tightened dramatically from 0 to 5.5% over the past couple of years, but that's from zero. And I view that as the abnormality. Normal is, I think, where we are now, 4.5% plus minus 25 basis points for the bonds. And I think the so-called neutral Fed funds rate is pretty much where we are right now.
They do pressure the multiple, though, right? I mean, there is an impact from higher interest rates. So you have to use the strong earnings, the strong economy that we have to continue to generate strong enough earnings to offset the higher interest rates, which would pressure the multiple, making it really hard to have multiple expansion again.
Well, I wouldn't really want to see much more multiple expansion. I'm expecting that this bull market will be increasingly driven by earnings over the rest of the decade. I think the important point about multiples is that, sure, they're impacted by interest rates, inflation rates, but I think first and foremost, they're impacted by the perceptions of how long economic growth is going to last, how long earnings are going to continue to grow. And I think that's why we have such high multiples here, is because the market's going to come around to our opinion that the resilient economy is probably not going to have a recession. That doesn't come with a money-back guarantee, Scott, but I think that between now and the end of the decade, the economy is going to continue to perform quite well. It would take a major increase in oil prices, I think, to cause a recession, and I don't see that. It would take a trade war similar to Smoot-Hawley, and I don't think that's where this is all going to wind up. We are going to have some tariffs, obviously.
Well, Smoot-Hawley didn't end well. I mean, obviously.
Right. That's not my scenario, right?
But why does it have to be to that degree? I mean, if you still have the introduction of tariffs and you do have even modest trade wars, you could have an impact on the overall economy, right?
Absolutely. But I think Trump is using some of the heavier-handed threats on tariffs to negotiate better deals with Mexico, Canada, China. I think his proposal to increase the tariff by 10 to 20% across the board is really meant to raise some revenues to reduce the deficit or stop the deficit from expanding. And that could lead to a currency war. I don't know that it leads to a trade war. If tariffs are raised, let's say 15%, and the dollar's already up 8%, maybe rises another 5-10%, that would offset a lot of that. And the impact would be on foreigners, the foreign exporters. If the dollar doesn't budge much, then Americans will pay that, and that'll have some inflationary consequences. So look, I think, as you point out, there's a lot of known unknowns, a lot of volatility up ahead here in terms of the economic data and policy moves, and that could create some volatility in the short run. But I think in the long run, the economy is resilient. Earnings will be $285 a share next year, and I'm at the top end of the strategist outlook for earnings next year.
All right, we'll leave it there. It's been a fun year visiting with you. Happy holidays again.
Same to you.
All right, we'll see you in 25. I'm sure of that. That's
Absolutely.
Edgar Denny. Up next, we track the biggest movers into this close today. Pippa Stevens is standing by once again with that. Tell us what you see.
Well, Scott, more than 20 stocks in the Russell 1000 have doubled this year. And up next, we've got the key names to watch.
All
right, we're less than 15 from the closing bell. Back to Pippa Stevens now for the stocks that she is watching. Hey, Pippa.
Hey, Scott. Over 20 stocks in the Russell 1000 have more than doubled this year, with the AI wave providing a big boost for many of them. So here are the top 5, starting with AppLovin, rising more than 760% this year, thanks in large part to the mobile app company's digital ad segment. Next up is MicroStrategy, jumping 470%, gaining a big following amid a record rally for crypto following President-elect Trump's win in November. In third place, we've got Palantir up 370% as AI and defense demand send the stock to record highs. Next up is Carvana, 320%. The firm has cut costs and restructured operations following bankruptcy concerns. And then rounding out the top 5 is Vistra. It has tripled in 2024 as the energy company fuels power demand driven by AI. Scott?
All right, Pippa, thank you. Pippa Stevens. Still ahead, game day for Netflix. The company streaming 2 NFL contests on Christmas Day. We'll break down what's at stake with the stock near record highs. We're back on the bell right after this. All right, up next, wrapping up a big quarter for discretionary, the winners and losers when we take you inside the market zone next. We're now at the closing bell market zone. Seema Modi on discretionary stocks leading during a critical time for retail. Plus, a big Christmas Day bet on football, of course, for Netflix. Julia Boorstin with that story. And Edward Jones is top strategist. Angelo Korkafis shares his outlook into the new year. It's good to have everybody with us. Seema, you first on discretionary.
Yeah, the timing is interesting, Scott. Amid the holiday shopping season, consumer discretionary stocks outperforming today with names like Starbucks, Amazon, both trading higher. Tesla among the standouts, up another 5% today. And then travel and casino operators, Caesars, MGM Resorts, Booking Holdings, posting gains at a time when market watchers are assessing the health of the U.S. consumer following that drop that we saw in consumer confidence data that came out yesterday. For the year, it's worth noting Deckers Outdoor, the best performing name in the sector, up 86%. New data out from Visa showing that of total retail spending this holiday season, 77% of payments were made in store and just 23% were made online. On the flip side, Nike and Lululemon among the worst performing consumer discretionary stocks on the year, Scott, down double-digit percentage points.
Okay, Seema, thank you. Seema Modi. All right, Julia, tell us about Netflix, this big Christmas Day football day.
Well, Scott, Netflix's NFL games offer a window into this company's future. More bets on sports. It just announced a deal for the next 2 FIFA Women's World Cups and a growing focus on ads. Netflix shares are up over 90% in the past year, in part on optimism about its ad-supported lower price subscription tier, and sports drive engagement that attracts ad dollars. Oppenheimer estimates that Netflix is generating $150 million in ad revenue for tomorrow's games. That's the same amount that Netflix is reportedly paying for them, while the games also offer subscriber acquisition upside. And for the NFL, Netflix helps grow its international audience ahead of its record 8 international games next year, up from 5 this year. And the league is considering doubling that number to 16 games in the future. Now, sources say Netflix would be a natural partner for those or other NFL rights, assuming, Scott, that the game is streamed without a hitch. But they say that they're very confident about their technical capabilities.
All right, we'll see what happens. Julia, thank you. Many are going to be watching. We know that. That's Julia Boorstin. Angelo, good to see you. Got a nice little move here before the Christmas holiday. How's next year going to look?
Yeah, as you said, investors are back in a festive mood, and there's good reasons to be optimistic for 2025. Of course, we have to keep expectations for returns and volatility realistic. About half of the gain this year has been driven by valuations and half from earnings growth. So as we think about the year ahead, likely it's going to have to be earnings that do the heavy lifting. But the positive is that the outlook looks good on that front, with potentially S&P earnings growing about 10% or slightly higher, more than that.
You think we'll get the broadening that some are clamoring for quickly?
I think it's going to be prudent to have a balance between the mega cap tech companies and some mid and small cap stocks. We still favor U.S. domestic equities based on a stronger momentum. But there's a couple of reasons to believe that the broadening might finally be realized in 2025. We have earnings growth that are also broadening, accelerating for the rest of the market versus the Magnificent Seven. We have domestic and value-style investments that are derive more of their revenue from the U.S. domestically, so they are less exposed to the trade headlines that we're unlikely going to see. And also, we have cyclical sectors like financials and industrials that could benefit from pro-growth policies.
All right. We're going to leave it there. Happy holidays to you and everybody as the bell rings out, and we are green across the board on this holiday shortened trading day. Merry Christmas, everybody. Happy Hanukkah. I'll send it into OT.
All right, that's the end of regulation time. The Council of Autism Service Providers ringing the closing bell at the New York Stock Exchange, as you're seeing there. The Little St. Nick Foundation doing the honors at the NASDAQ market site as well. The market leaving a nice gift for bullish investors on this holiday shortened trading day. The Dow extending its winning streak to a 4th straight day. The S&P 500 and NASDAQ higher for a 3rd day in a row. That's the scorecard on Wall Street so far today, but the action's just getting started here on the show. Welcome to Closing Bell Overtime. I'm Dominic Chu alongside Leslie Picker. John and Morgan, of course, are off for the holiday today, Leslie.
Every sector in the green today led by consumer discretionary. Tesla driving that sector higher again. And coming up, former Tesla board member Steve Wesley on the outlook for the EV maker under the incoming Trump administration. And FundStrat's Tom Lee on whether today's market gain